Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about property, plant, and equipment, PP&E, and we've been focusing on what kind of costs can be capitalized, debited into our asset accounts, instead of expensed, debited into an expense account. The basic rule of thumb we've discussed is everything we spend getting that asset ready to use, we can capitalize. Everything else has to be expensed. Now, we've talked about some specific issues that maybe are a little more challenging than that rule of thumb allows. That is interest expense, how much of that can be capitalized, if any. And then talking a little bit about basket purchases that are a little bit different in how we pay for them and how they're lumped together. And then talking about what happens with subsequent costs. So all of this discussion has been around building up our PP&E accounts and creating this historical cost or original value. Now it's time to talk about the flip side. What do we do when we're ready to dispose of the asset? Basically, the rule here is that when property, plant, and equipment is eliminated or disposed of, we have to get it off of our books and everything related to that asset off of our books, which means there's two pieces to this. There's anything that we've capitalized and all of our depreciation has to come off of our books too. We don't want anything in our accumulated depreciation account that isn't still there. We don't want that reducing the value of our remaining assets by having this big contra asset that relates to nothing. So in our journal entry, to show that we've gotten rid of this asset, we're going to credit away the asset value, we're going to debit away the accumulated depreciation, then the difference between what we're getting rid of and what we might get, whether it's cash or another piece of equipment, if we're doing a swap or an exchange, any difference becomes a gain or a loss on disposal. And that's really it. It's pretty straightforward to record disposals, especially if we're just talking about selling it off or just junking it. Let's take a look at an example of this. This is Harding LLC, and Harding has decided to get rid of one of its machines. Machine cost $1 million when they bought it 6 years ago. At the time, they thought they could use it for 9 years and then sell it for $100,000. But by the end of this year, year 6 from the time we bought the asset, they realize it's better off to just sell this machine for $350,000 than trying to keep it in good form, keep it producing for the next 3 years. So they've decided to sell it. And we want to make the journal entry, yes, a journal entry, to show the sale. So again, our rule here is we have to get rid of the asset and the accumulated depreciation. Now, I know the asset value. I paid $1 million for it. What I don't know is my accumulated depreciation. So I have to figure that out before I can do this journal entry. We haven't talked much about depreciation yet. We will. It's actually our next topic coming up once we finish discussing disposals. So for now, we're just going to use basic straight line. And you probably remember that depreciation expense under straight line, we take the historical cost or the capitalized amount minus what we think the salvage value is going to be, and we divide by the estimated life in years. So in this case, our historical cost was the $1 million we paid for it. We're not given any other information about installation or trial runs or anything, so we'll just stick with that. Salvage value, we originally thought it would be $100,000, and the useful life was 9 years. So 900,000 divided by 9, $100,000 a year. That's my depreciation expense. I don't need depreciation expense. I need accumulated depreciation. Well, I would have added this much into my accumulated depreciation each year for 6 years. So if I multiply that by the 6 years, I have 600,000 in my accumulated depreciation for this asset. So if I get rid of the asset, I get rid of the $1 million, I've also got to get rid of the 600,000 so that it doesn't keep reducing my total assets when there's no asset there for it to offset, right? Otherwise, it's just this negative, drops total asset value with no positive to offset it. If we're going to sell this off, then we have cash coming in, and we were told it was $350,000 was what we were offered. Accumulated depreciation, we've got to get rid of that. It's got a credit balance, so if I want to get rid of it, I'll debit that account for $600,000. And then I'll credit the asset. And this was a machine, so I'm going to call it machine, but if you want to call it PP&E or equipment, that's fine too. Every company is going to have its own convention for that. And now I need to know, do I need a gain or a loss to make this balance? Well, in this case, I need a debit to make this balance. And now the question is it a gain if you have a debit or a loss if you have a debit? Well, let's see. Gain or loss, that affects equity. Equity is a credit account. So if I've got a loss, it's working like an expense. That's a debit. And I've got a debit here. So it must be a loss on sale. And if we'd been able to sell it for $500,000, I'd have a gain because I would have sold it for more than I thought it was worth. So I would have shown a credit. I would have needed a credit to make it balance, and that would have given me a gain. This is the sale of machine. And that's it. That's all we're going to put in there. You can put in more details if you want to, but just make sure you don't leave it naked. All right, next example. What if instead of selling it, what if management decides, you know what, let's just junk her, because we can't find someone we don't like to sell it to. I'm sorry, that story about that car always just gets me chuckling. Anyway, now, told that story, I've lost my train of thought. Hold on. Right, so we're just going to junk it and take a tax break. And that happens quite a bit. If I can't get a good sales price, if they were only offering me $100,000 and I can junk it and get a 30% tax bump or tax savings, I may actually be better off junking it and taking the tax break than I would be selling it. So sometimes for tax purposes, this is worth it. So this is an abandonment. And in this case, I'm getting nothing. So I'm going to get rid of the machine. That's my credit. I'm going to get rid of accumulated depreciation, which we already calculated, so we won't do it again. And then obviously I have a loss because I need a debit. To make it balance. Abandoned machine. And took the loss. And that happens. If I can't find a buyer, just need it out of the warehouse, or it's better to sell it for scrap metal or whatever than try to find a real buyer, then I may see these. You'll notice too that with my gains and losses, I'm showing this is a gain or loss on sale, gain or loss on abandonment. Some companies will just show it as a gain or loss on disposal so that it's generic, so that their competitors don't know whether they were junking or selling or getting rid of equipment in another way. But it's usually more beneficial to investors to provide. This was this kind of a disposal. The next kind of disposal is a little bit more involved, and that's an exchange. Exchanging property, plant, and equipment means that instead of just selling it and walking with cash or abandoning it and walking away with nothing, I swap. And the most common kind of swap is if I go into a dealership and they say, hey, we'll take that as a trade-in. So that's the example that we're going to use, but this could easily be two companies that say, hey, you've got that machine, I need it, you've got a machine that I need, let's just swap these machines. So the entries are a little bit different for an exchange than they are for a sale or an abandonment. It all comes down to two big questions, what these journal entries will look like. First, is there a gain or loss on the exchange? Are we making money or are we losing money on this exchange? The way we decide whether or not it's a gain or a loss is we look at what it's worth to sell now versus what we show it's worth on our books. What's its carrying value? Meaning the historical cost or the capitalized amount minus the accumulated depreciation. If we show a loss, then we record that loss immediately. If there's a gain, then we move on to the second question here, and that is, does the exchange have commercial substance? Commercial substance means it would substantially change the nature of my business to make this exchange. So an example of this would be, if I take an old machine that makes 6 units an hour and I exchange it for a new machine that makes 600,000 units an hour, my business is substantially different. Hopefully substantially better. But it just means it's substantially different. That's commercial substance. If I have one delivery truck and I exchange it for a new delivery truck, then there's probably no substance there because I can't really go any faster. And I probably can't haul all that much more in that delivery truck. So really nothing's changed. I've got a newer model, it saves me some money in repairs, but really nothing's changed. That lacks substance. If it has substance, or if cash is involved, then I get to recognize the gain right away. So again, if it's a loss, I have to show the loss right now. If it's a gain with substance or with cash involved as part of this exchange, meaning I get cash, not that I have to give, not I give cash, but I get cash back as part of the exchange, then I show that gain immediately. If on the flip side there's no cash and it doesn't have substance, then I don't get to show a gain at all. It just kind of disappears. To show this, let's go back to that same set of information we were using before. This is Harding again. You remember that $1 million piece of equipment, $100,000 salvage value, 9-year useful life, so $600,000 in depreciation. And now let's say that instead of selling it or abandoning it, they're going to go and find this new machine. And the machine normally sells, the new one sells for $2.5 million, but they're going to give us this trade-in value. They'll give us a $700,000 credit for this old machine as long as we pay cash for the balance. And Harding's managers are all over this because they were only going to get $350,000 from selling this asset. I'm much better off with this exchange. Let's go ahead and go through the steps to recording an exchange. So step number 1 is deciding if there's a gain or a loss. And again, the way that I do this is I compare the fair value or market value of the old asset, not the new asset, the old asset, and I'm going to compare that with the carrying value or book value of that same old asset. So the fair value of the asset, that's what we could sell it for. And we did the journal entry for the sale. It was $350,000. That's its fair value. The carrying or book value, that's the historical cost minus the accumulated depreciation. So $1 million minus $600,000. So the book value was $400,000. And I'm going to subtract that. You can see this is actually a $50,000 loss. So I'm losing money on this exchange, not because the exchange is not a great deal, but because the asset itself has lost money. I think it's worth $400,000 on my books. It's really worth $350,000. It's a loss, and I have to show that loss immediately. So let's take a look at how we do that. Step 2 is to get the historical cost, or the capitalized amount, of the new machine. And I do that by adding the cash for the new machine plus the fair value of the old machine. Well, I know the fair value of the old machine. I just did that. It was $350,000. Comes from up here. Now I need the cash for the new machine, and I was given a market price. The new machine normally sells for $2.5 million, but they're going to give me a $700,000 trade-in value. Now, let me stop right here for just a second. I have a lot of people ask me, wait, I can exchange it for $700,000. That's my fair value. I've got a gain here. And the answer is, not really. Because an exchange value like this is not so much a market value as it is a sales hook. This is a trade discount. We talked about those when we talked about receivables. A trade discount is what a salesman can give you to talk you into buying the asset today. And that's what the $700,000 is. Some of it is actual value. I think as a dealer, if you give me that machine, I can sell it as scrap, or I can sell it to somebody else and make some money. So I really do think there's a market value there. But I'm also trying to give you more than the normal market value so that you'll buy my new machine. And so I can't use this $700,000 trade-in dollar value as the market value of the old machine, because those two things are mixed and I don't know which is which. So I'm stuck with finding out fair value a different way, which in this case, find out what people are willing to pay for it. That's the best way. So let's see, $2.5 million minus $700,000, I'm going to pay $1.8 million in cash. And if I add those up, then the historical cost of the new machine will be $2,150,000. Now that I've got those two steps done, it's time for the best step. And you can imagine what that is for me. Got to be the journal entry. So that's step 3 is the journal entry. And let's see, I know a lot of this. So I know the new machine is worth $2,150,000 because I calculated it up here. I know I've got to get rid of the accumulated depreciation on the old machine. And I know I've got to get rid of that old machine. The other thing I know I'm doing is I'm writing a check. Cash, 1.8 million. The only thing I'm missing is whether there's a gain or a loss on this exchange. And I already know the answer. If I've done this right, this will be that $50,000 from step one. So let's take a look. Add up the debits and the credits. What do I need to make them balance? Because I've got to have a journal entry that balances. Well, if you do the calculation, it turns out, sure enough, you need a $50,000 debit, and that's my loss. And sure enough, it matches with the loss that I show up here. That's the calculation so that I show that loss immediately. And to end this, this is record an exchange with a loss. Or something similar. You could throw more details in if you want to. We've talked about a lot of stuff with disposal. Remember, the key concept here is that I've got to get rid of everything associated with that asset when I get rid of it. So the historical cost has got to go and the accumulated depreciation has got to go. The rest depends on what assets I'm getting in. And so far we've looked at a sale, we've looked at abandonment where I get no assets, and we've looked at an exchange with a loss. We still need to take a look at what happens when I have a gain when I do an exchange. And we'll talk about that next time. I'll see you then.